And Adam, what I like about your notes is everybody's warning about earnings headwinds and weaker earnings, pricing in a recession. You're talking about a number of earnings tailwinds in the new year. Why?
Yeah, I mean, I think that you're going to see companies have aggregate demand problems as the economy slows, and that's certainly going to weigh on earnings. But I think there are three big tailwinds that are going to help earnings for next year come in better than I think people fear. The first one is supply chain normalization. You've heard a lot of companies this week talk about that. I think most notably Ciena, which reported earlier in the week, a mid-cap networking company, came in much better than expected, and largely because they were able to ship more products than they had anticipated because they're getting more chips, more components, and their supply chain is just operating in a much more smoother fashion. You had a lot of other companies talk similarly about improved supply chain conditions. I think that's going to be one tailwind. The U.S. dollar weakness, the U.S. dollar is off relatively substantially from its recent high. The dollar has crushed earnings for the last year and a half. It's been on a relentless rally. And so to the extent you see that continue, that's going to be another tailwind. And then the third one is just very aggressive cost cutting. You've heard on any given day, you have a slew of companies coming out with either hiring clauses, layoff announcements, aggressive operating expense reductions. And I think that's going to be a much bigger theme going into next year. That's going to contribute to some of the softness in the broader economy, but it will help preserve earnings for companies for next year.
So do you think expectations are getting too low here for earnings? Do you think there's too much pessimism creeping in?
Yeah, you have some pretty dire numbers getting thrown around for next year. So for the S&P 500 EPS, you have the numbers are kind of all over the place. The consensus among sell-side strategists is about 220. Another bottoms-up forecast for S&P is around 230, but a lot of people are mentioning figures as low as $200 or $205. Which would take just a very dire economic scenario, with ongoing margin compression, et cetera. And I don't think you really see the evidence for that taking place. So I do think that the narrative around earnings for 2023 has become a little bit too pessimistic.
So you're upbeat on your market outlook for 23?
Sort of. I'm not really too bullish. I just think that the combination of disinflationary forces, which I think will grow more intense, and some of those earnings tailwinds, which will help preserve earnings estimates for next year, I think that's going to avoid some of these steep sell-off forecasts that people are making. But I do think that the S&P is going to face a ceiling, essentially around where we hit earlier this year, around 4,100. That's just going to be a very tough level to break until you really see a sustained downward trajectory in inflation, until you really see the Fed not only really pause, but start to outline possibly dialing back a tiny bit, the tightening policy they've been pursuing for the better part of the year.
Adam, we'll leave it there. Thank you very much for joining me.